While you're reading this disclaimer, don't forget to subscribe, tap that like button, and bake yourself a cake because you don't have to wait until your birthday to celebrate something, do ya? And welcome to the next video in our Futures Basics video series where I'm going to be going over the tax advantages of futures. I don't know if you knew this, but futures trading offers some pretty unique tax advantages. In this video, I'll be going over the 60/40 tax rule and why it's beneficial. Now, before I get into the content, if you're watching this video on YouTube, click the link in the description to access the free members area so you can get access to all the slides, not only from this video, but all of the videos in this free course, any PDFs, guides, checklists, other resources that I provide, as well as notifications of any free live trainings that I do where you can look over my shoulder and see me trade. So again, click the link in the description and sign up for the free members area. Next thing I'm going to mention before I jump into this is not financial or legal advice. Please consult a professional. Again, this video is for informational purposes only. It's not intended to be a any financial or legal advice. Please consult a licensed professional for further information. Now, in the US, futures are taxed under the 60/40 rule, which means that 60% of your profits are considered long-term capital gains, and the remaining 40% are taxed as short-term capital gains, which is just taxed at the same normal rate as your regular income typically. So now let's just do a quick example so you can see exactly how this works out. So let's say, as an example, you have $10,000 in gains. Under the 60/40 rule, $6,000 of that is taxed at the long-term rate and $4,000 at the short-term rate. Again, 60/40, right? So now if you're in a higher tax bracket, this can lead to substantial savings over time. Now, these tax benefits make futures trading a very attractive option, especially for active traders who want to minimize the tax impacts on their short-term trades. So let's say you earn, just as an example, $100K a year, maybe a little more, whatever, of total income, and your long-term capital gains rate may be around 15%. Again, just for this example, which in the case of this example, $6,000 times the 15% is only $900 of taxes in this particular example. Again, your total income for the year is over $100,000 a year. You have $10,000 in total gains from trading. Above and beyond your W-2 job income, your business, whatever it might be. $6,000 of that is taxed at the 15% long-term capital gains rate in that particular tax bracket, only $900. Short-term capital gains is taxed as regular income, which could be as high as 22, could be 37%, again, depending upon where your tax bracket lands, which is between $800 and $1,480, again, by those different factors. So pretty much almost any way, you're going to be at 15% for the long-term capital gains, which is far less. And again, that's where most of the money is actually taxed in the 60/40 rule as well. So definitely very useful. Now, I wanted to add on some other related topics here because the 60/40 tax rule is definitely beneficial as a futures trader, but this isn't the only avenue that you need to be looking at. We could be talking about you creating an LLC and trading within that LLC, and also having itemized deductions, meaning writing off, your internet usage, any software that you're purchasing, i.e. TradingView or any other indicators or anything like that. The actual computer, if it's dedicated to you doing your trading from that computer, that can be an itemized deduction above and beyond anything else that you have as a deduction in your taxes. What about retirement planning? Again, you want to talk about building your nest egg and also using tax-free retirement strategies. This is above and beyond any day trading that you're doing, more long-term investing. And then having multiple streams of income or multiple streams of deductions. One category in particular that falls into this bucket is real estate. Real estate has many paths to increase your net worth, help you build a retirement fund, and also reduce your taxes. Again, not going to get into the intricacies of all of these, but I at least wanted to mention this as there's way more to consider than just the 60/40 rule. And again, I know I'm going to go into more of these things, not only on the YouTube channel, but in future courses that I create and everything. So again, make sure you like and subscribe on this particular video and this channel, and I'll be delivering more content here as the weeks and months and years go on. So by leveraging these tax strategies, you can improve your overall net returns, keep more of what you make. And in the next video, we're going to be covering points and ticks in futures markets, as well as how to analyze these various movements. So go ahead, Click on the next video and we'll see you there.